Chief Market Strategist at bullseyeoption.com. Alan, you're looking at a trade in uranium, name or ticker name CCJ. Cameco is the company. Why is this on your radar today?
Well, first off, I want to back up just a bit and talk about the market in general, because every week I come on here and I point out the positives, and there are a lot of positives to talk about. And we've seen earnings season beat expectations, and most importantly, I need to point out is that we've seen revenue growth of 4%. So companies are taking in more revenue, and actually companies that do 50% of their business here in the United States, their revenues increased 6%. So increasing revenue is a very positive sign in this environment, and the PE ratio is around 17. So what I'm looking for here is the markets to test the top of this 6-month range in the S&P. So that's very important. And the last of the positives that I see is Goldman Sachs has come out and said that the market's not going to break out. Now, for me, as a contrarian to what Goldman often says, I look at that as a positive.
All right, and we're also looking at Cameco, ticker CCJ. I do want to get your thoughts on that specifically, and thank you for running us through where we are up until now when it comes to earnings. So let's look at CCJ.
CCJ is a stock that's stuck between 20 and 30 for the year. It's got a series of higher lows and lower highs. So it's forming a wedge that we should see some sort of apex breakout here. Now it's trading around 28. This was a $56 stock back in 2000s when we had the commodity super cycle. Now, I don't believe that lithium is a seasonal product, but it's interesting that we put on a position last year. If you go into the archives there, we put on this position May 9th, a long call position, and we took profits of 85% in September. So what we're looking at here is, I'm looking at the 25 call again, the September 25 call. This is a stock that's 15% off the 2023 lows, and it's also 15% off the 2022 top. So it's in position, and again, I use a stock substitution strategy to position for success, buying enough time, and it'll act like the stock on the upside with a limited investment.
All right. Now, speaking of these different commodities, let's look at a gas commodity. Last week you had a trade on natural gas, and today you're looking at uranium, not just lithium, but uranium. Tell us why.
I'm sorry, uranium, right. I misspoke there. So, I'm looking at, and a lot of it comes down to what Ben was just talking about. All assets benefit, and especially commodities assets benefit from the dollar decline. So if the dollar is going to break down and make new lows, that's going to be very positive for a lot of commodities. So that's part of the play here. And so this option, September option, has 4 months of time. It's got a delta of over 70%. So like I said, it's going to act like the stock. It's trading at about $4.50, and it's $3 in the money. So it gives you a leg up. And again, we've been trading between 20 and 30. 25 is the midpoint of this range. That typically sends it to the top end of the range at 30, and a breakout above 30 targets 40. So if this stock gets to 40, this option will be worth 15, which is a significant percentage return on a $500 risk.
Are you keeping your eye on any specific energy trade, any other energy trade this week as well?
Well, I think energy does have the best risk reward. Ben and I have been talking about this for a long time. Crude oil continues to hang out at its lows, but it always has price pop potential. So I like the risk reward on a lot of energy stocks as we stand here, because crude is really the only market that hasn't had a rebound yet, and the dollar decline could be that catalyst to give it a pop. We've been largely between 70 and 90 for months and months and months in the crude oil segment. So I think they were leaders last year, and they're laggards now. So from a risk reward standpoint, I think a lot of the energy stocks, and again, I'm an options player, so I position myself with time in some 3 to 6 month options, looking for that gentle turn. But yeah, I think that's one sector to really take a look at, because a lot of others have already taken off, and they don't offer that risk reward that some of these energy stocks do.
All right, Alan Nuckman, thank you for taking us through all of that. And coming up, you've heard the old investing phrase, sell in May and go away, right? Well, that may not apply this year. We'll tell you why up next on Morning Trade Live.